Hello, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 7th of March, and we have crude oil trading essentially little changed at around $82 on Brent. I want to kick off this morning in China to get a sense of where we stand with Victor Yang, Senior Analyst at JLC Network Technology. Victor, it was great to see you in London last week. And I wanted to get your thoughts on the decision, the announcement by the Chinese government earlier this week to set the target for 2024 growth at 5%.
Yes, hello, good morning, Sean.
Good morning, Victor.
Yeah.
You got home safely from London?
Yes, quite smooth, yes.
Good.
And it was nice meeting you there too.
Absolutely.
Yeah, as
Although we
we
missed
also,
Richard, but we won't get into that right now.
yes,
Wish I was there.
Wish I was there, exactly. Victor, please.
yes, okay. And we also talked about this target in London. As we had expected, the target was set at 5%, about 5%, and it came as no surprise. The government set the target higher than most international companies expected because first is under pressure to create more jobs. As we know, in 2023, the country tallied a growth of 1.2%, but some industries shrank and some others grew, such as the exports of lithium power cells, NEVs, and so on, the surge. But some conventional industries, labor-intensive ones, shrank. And these new industries, like NEVs, lithium power cells, they are not labor-intensive. So there was some kind of loss of jobs, actually, in some industries. And the government is under pressure to create more jobs this year. And second, it seems more confident than most people. It's now depending a lot on policy. Yes.
Yeah,
Yes,
go
Sean?
ahead. Go ahead. No, go ahead.
So it depends a lot on policy whether the country can achieve this target of about 5% of growth. As we know, it has rolled out quite a few stimulus this year, including cutting the reserve requirement ratio and mortgage rate and so on. So more stimulus are expected to achieve this goal.
The insight into the outlook for demand, Arne Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Is this a market looking for greater control of supply, or is it a market looking for demand?
Oh, that's a good question. I think there's of course a lot of focus on the supply side now, whether OPEC will be able to do the cuts in Q2 after the extension over the weekend, where's Russia in this game and so on. But I think that Victor has a very good point of course China is the big elephant in the room here. One thing is of course to set a target of 5% growth. That's pretty easy on paper. Now the difficult thing is of course to actually achieve 5% growth. But I actually do think that there are signs of improvement in the global business cycle, in the global manufacturing cycle. We do see a tendency to, like, global PMIs are actually slowly picking up. Things are slowly improving. We actually saw import-export numbers out of China for January and February this morning, maybe a bit higher than expected. There's a lot of base effects here and so on, so we have to be a bit careful. But yes, things are actually improving on a global scale, and of course that will also benefit China. But of course supply is important. One thing is OPEC, the other thing is of course that everyone discuss every day what is happening with the US supply. Would that be another 1 million barrels this year as last year? That's a big question. But of course you cannot have oil prices at 85 or whatever without some demand growth. But I actually think that things are improving. There's also something that people seem to forget. Remember, oil demand is always a seasonal thing. So, and we are actually moving into Q2. We are moving into Q3, where there's a bit of a tailwind to the demand side, because we move up the seasonal ladder, because demand is always stronger in Q2 and going into Q3, basically the driving season, right? So the task is probably a bit easier for OPEC at the moment. So whether it's a demand or supply question, I'm not sure. Everything,
well, Richard,
both are important at the moment, I guess.
Of course, always both, always both. Richard Radoglia, CEO of Matrix Global Holdings, sitting in California. Obviously, the big, there's China is, of course, the big story and has been for a long time on that marginal growth, demand growth. But the US remains ultimately the pillar of, many would say, of this global oil demand story. Your outlook for the US, we've had the Fed chairman out yesterday saying that he sees no signs yet as to start a rate cutting cycle. The US economy looks still strong and robust, and with it, oil demand. Your outlook for demand in the US over the coming months?
I think, well, to your point, it is a good supply-demand argument here, and I think U.S. supply is something we can talk about in a second. Demand is stable. I guess the question I have is what is the actual energy demand GDP ratio in the U.S.? I mean, is a 3%, is 1.5% demand growth? What does that translate into? And I think what we look at is a U.S. that just kind of goes along. And I would think this for all OECD countries, that demand is relatively stable. The economy seems to be doing well. Remember, we have $1 trillion of deficit every 100 days now in the U.S. So the concern really is how much is real? Is it economic activity? Is it government spending? $1 trillion every 100 days is the largest deficits we ever had, and so is part of that was driving what economic activity. I think we are seeing a lot of interest, interest in AI. Bitcoin now I think is now 2% of energy usage in the United States. I got to go look at that statistic again and see if that's a real number. But I think the U.S. from a demand perspective is going to stay stable. There's no reason to think anything is going to change. It's really the supply perspective is.
Well, on that, Richard, supply, we were in IE week last week in London, and there seemed to be a bit like the OPEC IEA forecast for growth and demand this year varying from 1.2 million barrels a day to 2.2 million for OPEC. On the US oil supply growth story in London, we had a contrast of under 500,000 barrels a day by some secondary market analysts to 1 million barrels a day from others. It was a big range in the context of a tighter overall global demand growth story. Not a lot of wiggle room there, but a huge variety of voices in US oil supply growth. Your thoughts on where do you think it may be going?
I don't think I'm qualified. I think let the experts who come up do 500,000 and 1 million.
Sure.
Let's just look at the market. The market is firm, and not only is the market firm, the backwardation is very well firm. Is remarkably steady. I'm looking at the backwardation. I'm looking at the Brent backwardation now. The U.S. has done. The energy markets are remarkably efficient. They've done something remarkable. U.S. oil exports have gone to 4.4 million barrels a day. I believe, and what we have got some statistics here. We saw a destination from Asia to Europe. A flip here. It flipped from 15 million barrels to 5 million barrels in Asia, and it flipped the other way, going to Europe. And what the biggest thing I think we've experienced here is that WTI is now deliverable into the Brent complex. That is remarkable. Brent used to be deliverable into the WTI complex decades ago, up the Seaway pipeline and up into the Mid-Con, up the CAP pipeline into the Mid-Continent refiners. So we've seen a total reversal here. We have a remarkable thing that's happened, that the U.S. Has become a supplier now, and I think a price setter now for Brent. And what it shows is that the WTI flowing into the Brent complex, even with those barrels flowing into the Brent complex, the 1 to 12 month spread is trading around $6 backwardated. And so whatever we think about supply and demand, I think we have to just assume that the market is looking at it. And I've said this to you before, Sean, I think you agree with me, is that information technology is so fast. We see things so rapidly now between Kepler, IHS. Everything is calculated immediately. There's no more wiggle room. Forward volatility has collapsed. And so I think what we're experiencing here is a kind of a renaissance in information. It's happening, and the market is giving us the information in real time. And so,
and maybe that's one of the explanations, amongst a few other things, perhaps, as to why this market is so sedate given the dramatic. I mean, just headlines this morning of a ship sinking in the Red Sea after being hit by a missiles from the Houthis earlier this week and damaging long-distance telecom cables, and the market didn't even blink because it has so much real-time data from other sources. Let's go back to Victor in China. Victor, I wanted to get your thoughts on again, this is a supply data story, it always is, but ultimately the demand side story in China. We saw that we have the data now for the first 2 months of 2024. Chinese oil imports are down from December. They're in January and February, we had an average of about 10.75 million barrels a day. And in December, we were at 11.4. So we're down about 700,000 barrels on imports for January and February. What can we read into that? Does it mean anything? What does it tell you about how this goes forward? Chinese oil imports.
Well, if we compare imports with those in December, it doesn't make much sense because we had the public holiday in February for the Chinese New Year. But when we look at the year-on-year comparison, compared with the first 2 months in 2023, it actually grew. Say in the first 2 months of last year, the imports were about 10.4 million barrels per day. But in the first 2 months of this year, it actually grew to 10.7 million barrels per day. So there was some kind of modest growth in the first 2 months, year on year. But imports in the first 2 months are usually relatively low because of the public holiday. So we still expect larger imports in the coming months, despite more maintenance in the second quarter. But when we look at the whole year, we expect much slower demand growth. Say last year, we heard a lot of talk about China's demand being weaker than expected. But at the same time, we saw the country's crude processing surge to a new high. Yeah. And for this year, we are still expecting another new high, but not such a dramatic rise again. And say in 2023, we had a surge of over 1 million. Say about 1.18 million barrels per day in crude processing. But in this year we might just see an increase of about 200 kbd in crude throughput. Yes.
Arne, I wanted to get your thoughts on the Saudi OSP prices for April, which were just announced yesterday. The idea that Saudi Arabia sets its crude oil, OSP, the official selling price of its future oil. We've seen in the first few months of this year some serious discounts into Asia for its Arab Light crude benchmark, and that was seen as a sort of the heating up in some ways of market share competition in Asia. Your thoughts on the OSPs for April? We've seen the official selling price of Arab Light crude to North America at $4.75 above the benchmarks, and
they were high 20 cents, if I remember correctly, to Asia, right?
Yeah, exactly.
Yeah. I mean, it's a small hike, to be honest. and we're still well below where we had half a year ago or something like that. But I think it underlines that the demand is actually picking up. The cuts are working. They are actually able to charge a slightly higher price. So I think it for the market it's comforting that they are actually able to do this and keep it. And it might also, as Victor says, be an underlinement that that Asian demand is actually a bit better. But a lot of the numbers are, of course, very hard to interpret here in January, February, as Victor said, due to the holidays and so on. But yes, I think on the margin, this is a positive sign. It's a sign that there is actually demand for the Saudi oil, and they are able to charge a slightly higher premium. It might also reflect that there's of course still a lot of Russian oil coming to that area.
Richard, we must acknowledge that essentially the Republican Party candidate nomination process ended yesterday with Trump winning overwhelmingly across what they call Super Tuesday states. All of the and Nikki Haley finally threw in the towel. I mean, it was predetermined from some months ago, but ultimately the date has arrived. Donald Trump will now be the Republican candidate. And most likely a rematch against President Biden. Your thoughts on that now that we move into a general election framework earlier maybe than normal in the usual cycle of things? Instead of a 2 or 3 month general election, we're now going to have 6 or 7 months. What impact, ramifications will it have, do you think, for the oil markets, for the outlook of the U.S. economic activity?
I don't think it much for economic activity. I think that, we have to look at let's look at who's in charge right now. Biden's in charge right now, and we have to go look at his energy policies. And his energy policy has been kind of a somewhat misguided. We have the LNG export delay. Even though LPGs, I think, hit record highs. We hit record highs on crude oil production or exports of 4.4 million. So I think part of it's going to be a push on the Democratic side to say that we still want to be energy. They're caught between a rock and a hard place. They can't do things that are economically advantageous to the U.S. that have to do with increasing oil production and or exports, at the same time keep their green agenda. And I think really that's one of the issues that they're facing right now. We're seeing the large oil majors basically saying, ExxonMobil and Chevron, you see what they're doing. I kind of coined the phrase, there's oil majors and there's woke majors. And when you look at the two, you look at the European oil majors, their 5-year stock prices are down about 10%, 7-8%, while the US majors are up between 30 and 40%. And so they're basically going completely towards oil production. They're going to continue to push on the Permian. They're going to continue to push exports. They're going to expand export capability out of the U.S. Gulf Coast. That's going to continue. And so one of the things that we could start to hear, and this is going to be a big question as far as the allocation of capital, is if there is a Trump presidency and he does come to power, I think we're going to see a reversal of the Inflation Reduction Act, which in reality has been the biggest push, has been a Green Transition Act. And so I think if there's something to look at, it's not right now. It's this kind of next year and a half out, where we're going to see not only how does the U.S. change its policies as it relates to being an energy exporter versus what it is right now, which is really trying to have everything. It's trying to be a green consumer. At the same time, it's trying to reduce its LNG exports, which is giving other countries around the world the ability to step up and fill their void where the U.S. is stepping back. And so I think that's really what we want to look at. Not so much the effect on current demand, but what's it mean for future supply?
Let's go to the survey question and get a view of the room. This is a kind of mirrors, and we made this prediction some months ago that the rate decline down the downside of the mountain would be as dysfunctional as the upside of the mountain when the market miscalled all of it, and the Fed did the same and signaled, and now we've had the opposite, right? The expectation signaling was very bearish earlier from the Fed even, and also from the market, with 7 rate hikes expected as recently as forecasted at the end of last year. Now we're down to a kind of consensus around 3 and declining. So my question today is, how many rate cuts do you expect the Fed to make this year? Powell reiterated yesterday that the Fed needs more confidence on inflation under control to proceed with cuts. So how many rate cuts do you expect the Fed to make this year? 3, 2, 1, or none? 3, 2, 1, or none? That's the question there. Victor, the big sort of question for China ultimately is the willingness of the government to drive more stimulus. You mentioned it in your earlier point. We've had some sort of soundings to that effect at the National Congress meeting recently. Your thoughts on the expectation that China could make more stimulus, and would it be of a scale? I mean, it's one thing to press the button on a few little things, some stimulus around real estate or whatever, but what's your thoughts on a stimulus that would be of scale to give more confidence from global investors and national investors that indeed this 5% target is real? Because the 5% growth target has landed with a lot of cynicism around it. Last year, there was a sense, 5% could probably be achieved because we're coming out of COVID from a very low base. But 5% this year does seem to have not a lot of confidence behind it. So your thoughts on greater stimulus that would really move the needle in reaching 5% growth this year?
Well, yes, right. It would be harder to achieve this target. Excuse me.
Drink of water.
It would be
perhaps.
harder to achieve this target this year. And the government needs to push forward with the upgrade in some new industries, say like the high-tech industries, increasing investment in these sectors. And it's also trying to attract more foreign investment, including investment in the petrochemical industry too, so in some high-tech industries too. And at the same time, more stimulus is required for the real estate industry. For now, people would care more about the real estate industry in China, I mean, domestically too, because it has a lot to do with their wealth spending, whether they would purchase an apartment this year. So this is still a kind of driver, could be a driver this year too. Yes.
Arne, looking to just a sort of a local, we've got a sense of the picture in China, a sense of the picture in the US. Where is Europe at? I mean, in some ways it limps along on the outside lane, but never quite collapses. The dreaded recession is coming and it sort of creeps in, but it's technical rather than dramatic or of really being a game changer. Where does the Europe look as we sort of come to the end of the first quarter in 2024?
I think what's happening in China is, of course, extremely important for the German export machine, and they are suffering from low export there. But things are slowly improving. The lower energy prices, gas, power, EUAs, the carbon emission price is coming down. It is supporting the economy. The service sector is doing quite well. So things are improving, but it's from a very low base. That's the problem, and the growth rate is very, very low, if any. So it is a concern. We had the ECB meeting today. I'm pretty sure they will acknowledge that. They will acknowledge that inflation is coming down. I think they should cut rates today. They will not do that. But rate cuts are also coming in Europe from the ECB. But I think the case for rate cuts is much bigger in Europe than it is in the US. And I think it's time for the ECB to realize that. I think they should move on their own, saying that things could go down. But of course, they are concerned. Wage growth is actually pretty high. And of course, if you have wage growth and you have no economic growth, it's a bad combination. It spells inflation, but it also spells a scenario where the consumer will actually be pretty well off for the next 12, 24 months. Then the final thing is actually related to also what Richard said about energy prices. I think it's very important for Europe, and it's very important for investors that they are pretty sure that we have stable energy supplies from the US. This ban on new LNG investments from the Biden administration is certainly not supporting Europe, because would you dare to invest in Europe because that is long-term
But are we not
investment?
in Europe? Are we not in Europe realistic to the? Again, it's a question I asked Richard earlier, and I think I'll bring it back here, is that we have to be cognizant of general election sound bites. Jumping off, the building is on fire because Biden has made what is clearly a general election announcement to suspend new licenses. No impact whatsoever on existing licenses. I think European politicians and energy policymakers are wise to what is a general election policy rather than some kind of shift.
Sure.
Your thoughts?
No, sure. But it creates this uncertainty. By the way, I'm not sure that the Trump administration will just open the LNG taps, because it's also an advantage to have cheap gas in the US, because then you will have to move your production to the US. That's another view on that. But yes, and there's actually a lot of things going on with the green transition in Europe. We can actually, the demand for gas will go down over the coming years. There's little doubt about that. But yes, we have to sort out our own house. No doubt about that.
Richard, last word to you. The survey result showing that we're now down to 2 rate cuts from 3. I'm putting my neck out on the line and doing none because I don't think, as you go into the second half of this year with the US general election raging, that you would make a rate cut unless there was sort of screaming economic requirement. That's my view. It's always been. Richard, last word to you on this. Again, other energy and other policy making that could be impacted by the general election.
Well, I think Arne made a point. I think Trump would get rid of all LNG. He would start. We'd have it'd be everything. I think the biggest thing that's happening is politics are going to come home to roost. I've not been a supporter of the transition, and I've made that known. I think that it's done incredible damage to the German economy and will continue to do damage. We're seeing Wilders now in the Netherlands. We have Meloni in Italy. We have Malou in Argentina. I think Trump has a shot. He's leading right now. He has a shot of winning. We're seeing the cost of the transition, and the cost of the transition is causing things to be very expensive. The U.S. has the capacity to produce a tremendous amount of energy. Natural gas prices have come off $1.75 low, so they might, if you have LNG exports, well, they might go up a little bit, but I think it'll be a tremendous benefit to the balance of your trade balance by allowing it to be more dollars for LNG. And I think, Sean, I disagree that even though what Biden has done is something that is politics, which I 100% agree with you. I think that's exactly right. And I do agree that none is the way that should go with the Fed. To ship onto that for a second, if we lower interest rates in the United States, housing prices are going to explode. And that is extremely inflationary, both for housing and for rent. But as it relates to delaying the LNG plants, those plants have to be, that's a long lead time, not just on the supply to build it, but on where is that LNG going to go? Who's going to take it? Is it going to be Pakistan? Is it going to be, what countries are going to take it? And who's going to replace them? And those decisions, yes, they can wait for 3 or 4 months, but how long can they wait? And that uncertainty is something that I'm not not sure that the rest of the world wants to wait for. And does that allow someone like Iran and Russia to do it, or and Qatar to do it? So I think it's a hodgepodge. It's been a confusing U.S. energy policy. I think that we're going along the same path. OPEC is going to continue to do what it's going to do. I think they're going to continue to hold their production very tight. I think I expect that to be the case, and for backwardation to persist going into the new year.
I would agree on that too. Brent crude oil trading at $83, more or less flat this morning. I think from an OPEC producer supply point of view, they would be quite happy with the current sort of boring oil market stuck in the low 80s. Everybody seems to get what they want from that. Thank you so much, as always. Great to have the insights of this amazing team. Victor Yang in China, Richard de Goglia in California, and Arne Rasmussen in Norway. So thank you so much, guys. Or sorry, in Denmark.
That's okay.
Close by, but very different. I appreciate
like
that.
Mexico and Egypt.
I mean, when anybody says Ireland and England, my sort of hairs go bonkers. So I appreciate that. That's.
But I think it's a Norwegian name, so fair enough.
Yeah, exactly. All right, guys.
Thanks, Sean.
Thank you. Have a great day. All the best.
Have a
Bye-bye.
good day.